All right, ladies and gentlemen, I hope you had a wonderful weekend. I have a special watch list to start off the week. Not only are we going to talk about what to expect this week, but we got to talk about what happened last week and understanding the sell the rate cut narrative. So if you are not aware, the last 48 hours in the market were absolutely wild. And if you go look at global central banks across the world, we are having the fastest pace of rate cuts since COVID. So I don't know if that sticks out to you or not. If you don't recall, it was just a couple of years ago we were getting the rate hikes. And if you recall, as the rate hikes were starting to happen, when they first happened, people got very scared of rate hikes. And then they were like, oh my gosh, the market's going to sell off. But then once they actually happen, everybody started getting bullish, and after your first set of rate hikes, the market started running up. Fast forward till today, everyone's talking about rate cuts, and initially everyone's like, yeah, this is really good. We're excited. Oh, real estate's going to go up, all of these different things. But now that we're getting the cuts, Wall Street is reacting negatively, and people are getting a little worried. So I want to explain that to you. I want to go over some of the history of other times where we have had cuts, how the market is taking it both good and bad, and what that means for you right now. Why this is so important, man. Shout out to the watch list, man. Literally, I have been making these videos. This was about 9 days ago on the live watch list on Thursday. All we were talking about was the yield curve, and we were talking about bonds and understanding this rapid tightening. About a month ago, I made you a video related to the bonds, and we were saying exactly when to buy TLT and understanding the rapid steepening. Oh my gosh, that was a month ago, and look at where it was. And then you fast forward till today, this is where our yield curve is at, and it has steepened rapidly. So a lot of you were able to make a lot of money on the bond trades. Like literally, the bond market has moved a lot. We're even going to talk about it because after the jobs report we got on Friday, you could see this pummeling of yields. And right now, Wall Street is expecting that the 10-year is going to go to 3.5 if all of this stays up. So we have a lot to talk about. I'm going to go over what happened here again this last 48 hours, the ISM manufacturing, how that led into the non-farms and the reaction. It is all key. The VIX is hovering below 30. It was there on Friday, but now this week we're going to have a lot we're going to get into. So Chad, what I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. And please watch the watch list because it pays off. I hope you guys got a dividend. And today is Sunday, tomorrow is Monday. We got the random account generator. I don't have it up here, but what I need from you, a random option trade. Keep it below $100, and tomorrow morning we are going to be picking a random option trade and seeing where that account takes us. So Chad, run it, baby.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then it feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
So right off the bat, before we get into the sell the cut narrative and understanding that history, I just want you to know how the last 3 days of the market played out. It was the end of the month for July. We thought it was about to be our first red July in over 10 years. And then all of a sudden, data came out, earnings, everybody was feeling good, and then we rallied. Everything was fine. And then it was on Thursday, we had the ISM manufacturing data, and literally right when that data came out, a lot of things flipped. Now, here's the deal. Why did that happen? If you weren't aware, I got to learn this. Apparently, there is a very tight correlation between ISM manufacturing payrolls and the PMIs as well as the non-farm payrolls. So anytime ISM manufacturing has declined, so has the non-farms. I believe the literal stat here from Bank of America, they say it was 84 through April 86 was the last time the ISM stayed below 50, and then the payrolls actually stayed up. So the fact that we had ISM manufacturing collapsing on Thursday, that's what led people to believe we were going to get a bad jobs report. And then on Friday, the jobs report came in at 114,000. It may seem like a good number, but compared to all of the other numbers we've been getting, that is a very weak number. It's one of the weakest numbers we've actually gotten here in years. And this started to lead people to say, oh, wow, maybe the jobs market is about to start cratering. faster than we expected, and then maybe now we might actually have increased odds of a hard landing, and then people started freaking out. So how does that apply to right here, right now? Quite simply, the data on Friday was leading people to think that rate cuts might be sooner, especially after Jerome Powell. People were getting that vibe, and that data confirmed it. But now this is what I want you to understand. Just like we talked about at the beginning, when everybody was hiking rates, everybody was scared of that at first. They're like, oh my gosh, rate hikes are bad, but you may have heard that phrase, buy the first rate hike. Well, now here is the whole sell the first rate cut. What has happened? So here's the first thing, and this is from Bank of America. Mr. Michael Hartnett, he has gone through history to show this, and he says there has been 12 occasions since 1970 where the Fed has cut rates for the first time, and there's 3 types of Fed cuts. The first one is a soft landing, aka you pretty much cut while everything is coming back, growth isn't slowing down, and you're normalizing rates. The other one is a hard landing where you have to cut to start stimulating demand, and then the third type of rate cut is a crash or a credit event, meaning something happens and it's kind of an external, and then they need to spur activity by utilizing the rate cuts. So that's what you got to ask yourself for now, because, well, if we're about to start getting cuts, people are freaking out now. The data hasn't done anything. We're in the middle of earnings. What type of cut are we going to get? Everybody is still believing in the soft landing, but if the jobs market starts deteriorating rapidly, we may get into the hard landing. That's what people are worried about, because if you start cutting while the data starts turning bad, that is not a soft landing rate cut. So the only way you get a soft landing rate cut is if the Fed is cutting rates and the economic data all stays elevated. So if that data, like the jobs number, starts cratering while you're cutting, it is very hard to claim that you have a soft landing. So that's the first part. The other part, he says panic cuts are when the Fed is cutting in response to a Wall Street crash or a credit event. 1987, 1998, those were panic cuts. And what happened? The S&P actually went up 20% on average 6 months to post cut. So right now, if everybody starts freaking out of nowhere and we do get that emergency cut, I was talking to them about this on Friday because a lot of people are like, oh man, are we going to get an emergency cut? And I said no, but it's possible. It all just depends on what happens over the weekend. So now we didn't really have anything bad. We'll see what this week does, but why I'm bringing that up, here's a fun fact. The Fed has never done one of these surprise emergency rate cuts with the VIX below 40. So if the VIX does go above 40, I would not be surprised if we started seeing panic cuts. But again, 1987, 1998, that's what happened. And then 6 months later, the S&P 500 was trading high. As long as the Wall Street event is not felt on Main Street, then you're able to brush it off. In 1998, they had a credit event. They did a panic cut. Everything rallied. It never reached the consumer. 2008, it hurt Wall Street. It hurt the banks. But then that ended up hitting the environment. In that case, your panic cuts or anything, they were not able to help out. The next set of cuts is the soft cuts. And this is what we were saying, where the Fed cuts into a soft landing. They start to lower the rates as the economic data does not turn on them. This has happened a couple of times, and this is literally the soft landing, 1984, 1995, even 2019. And what happens about 6 months later, S&P goes up 10%, and the bonds get a bid, and they drop by 56 basis points in 6 months after the first cut. I'm like smiling saying that because if you didn't see how bonds have already moved in this last week, you know, it's way bigger than 56 basis points, but that's the soft cut. And then finally, the hard cuts, that is where the Fed cuts into the hard landing, meaning as they are cutting, the data is deteriorating. That was 1973, 1974, 1980, 1981, 1989, 2001, and 2007. And the S&P has been down by 6 months, or 6% in 3 months. And then bond yields have dropped 38 basis points in 6 months, plus a huge curve steepening on the 2s and 10s after that occurs. So pretty much after you get your hard landing, you will get a huge normalization of the yield curve. So there's a little bit more here, but I hope you're getting it so far. Why I'm bringing this up, because this whole idea of sell the first cut it's true. There's a lot going on. It just depends what we get. And that's why we don't know how things are going to play out, because we're sitting in a very unique scenario right now. So we don't know whether the data is going to turn, whether it's going to stay up, what the economy is going to do. Do we run into an event? But depending on how we get that cut, which is now right around the corner, there's a lot of potential outcomes that occur. So that's what they're saying here. We say sell the first cut as hard landing risk, now 11%. Remember when I made you that video about a month ago, it was only 5%, are clearly rising at a time that strong, soft, or no landing consensus is still rising. And then finally, this part is huge, and this is where I think it gets super wild with this whole rate cutting cycle right now. One very important difference in 2024, there has been an extreme degree to which risk assets have front ran the Fed cuts. Stocks are literally up 32% in the past 9 months versus an average of 2% in the run-up to the last 12 occasions since 1970 where you've gotten your first rate cut. So if you don't know what that means, it's just saying we are now in this like whole front run, or like, oh yeah, Fed's going to cut, the economy's going to do this. Usually stocks go up an average of 2%. This time around, we are already up 32%. That's why I'm like smiling and laughing when I'm telling you how things have moved the last time, because the bonds have moved well over 30 to 50 basis points. Literally, that steepening of the curve, it's almost done half of what it did after '08, and I'm showing you that from the last time I made a video on it a month ago. So a lot of that stuff is what's giving us a little bit more, lag on the leash or slack on the leash, where we could do a lot of stuff. And now here's where it's talking about the run up. Where is it? Oh, low, there it is. But here's that chart just saying the run up till the first cut. So when you're actually looking at things this time around, we have ran up a lot more on the S&P 500. There was 1989. The first cut was 12 months before the recession, and they had a 21% run up. Again, we did have that soft landing in 1995, but they did it after there was a bond crash. But any other event, man, how we are moving pre-cut, there is a lot more slack than any other time in history. But the point is now, all of these places around the world, the pace of the rate cuts and all of that and what everybody's doing, this is now going to be the next thing over the next couple of months that, well, depending on how this goes, soft landing, panic cut, or hard landing, we are really going to start outlining where we go in the next 6 to 12 months as a result of all of this. So I hope you're prepared and watching all of the watch list. So let me know what you think, Chad. If you have any follow-ups, let me know, and I got you. But now getting into the keys, like I was telling you a little bit earlier, we were worried on Friday, everything from the VIX to the market, but now nothing is snapped over the weekend. So that's the good part. You just got to be aware now of what really went down over the weekend, or last week. That's why I really hope you understand the whole thing going on right now. Yeah, there's some data here and there, but it's all about the data leading into the rate cuts now and what happens to the economy when we get the rate cuts and how people are taking the rate cuts. That is the story both here in America and all across the world. The only thing I could give you that we didn't already cover with all of it that you got to really understand now, bad news is now bad news. Good news is now good news. We have gone this back and forth narrative for a while now. We were just talking even a month ago how it kind of shifted up a little bit, but now it is very clear, especially out of Friday, bad news is now bad news. You may get a hiccup and you may see some data do the opposite, but for the most part, as we start getting rate cuts, that might throw us back to normal in terms of bad is bad, good is good, and things could be a little easier to read moving forward. So watch out for that. That is key number one. Key number two is understanding what data we have this week. So I do think this whole back and forth and what we're coming off of, the VIX, the currencies, again, I haven't even mentioned the yen or Bank of England and all of that, but as far as what we're going to be dealing with data-wise, the ISM services, not as important as the manufacturing. It's funny because we didn't really care about manufacturing because services has inflation, but now that the non-farms are starting to go, that manufacturing had way more importance, but I would watch out any ISM employment and price. Those will be important, but those are our only sets of data this week. The only other thing you're going to be getting is a bunch of Fed speakers, and I could almost guarantee it, they are going to try to walk you back from the ledge. And what I mean by that is people were freaking out on Friday, even on Thursday. I would even argue some of the market freak out is a tantrum, and it's a little bit bigger than it should have been. And you even heard a couple of Fed speakers, they're all coming back saying, well, it's just one data set, just one data set. I wouldn't be surprised if we hear from Powell and he's saying, yeah, we expected this. So I really think the narrative, all the Fed speakers, they're going to talk about the data, talk about it slowing down, but they're all going to act like they saw this coming and that this is normal, just like they did in the beginning when things got volatile. Remember, in the last 18 months, the only thing that's changed is how the market has responded to data and the Fed. There's been a lot of confidence that the Fed has been on the right path and that they've been doing it good. So we'll see if this little event and the jobs data turning fast, if it shakes that confidence. Otherwise, all the Fed speakers this week, they're going to say the same thing, and they should boost things up there as they calm people down, and then we'll see where the ISM data takes us and go from there. But finally, your last key of the day. Oh, don't get the place. There's still a lot of earnings. So I think it's going to be a case-by-case basis from here on out, meaning some individual names will get more attention and could drive the market, but you've gotten the big dogs out of the way. You've gotten any of the other bigger names here related to either tech or AI. I think NVIDIA will be the final one. There will be the littler companies, but the narrative moving forward is all about whether the Fed is behind the curve or not, if they're cutting too early or too late, and if growth is actually slowing down. That's what people are worried about, whether we get those cuts in September and now tying it into the narrative of the Fed being faster, slow in growth. That is all we're going to be focusing on. We've gotten the big earnings. I think those will just sprinkle a little here and there on what we should be watching for. So keep your eyes out for all of that. It should be an exciting week. We will see if the volatility keeps going crazy. But now, let us get into the plays. So, right off the bat, I have a couple of different plays for you. I'm going to start with the first one from over the weekend. This one, it's kind of mind-blowing, and I really can't wait to see what it does on Monday. But Apple, if you did not hear, there was Berkshire Hathaway earnings over the weekend, and come to find out, Mr. Buffett and Berkshire has sold about half of their Apple stake. The interesting part, none of this is on a SC13, and here's the funny part, they have been selling off pretty much right around the era, right before and right after Apple announced the Apple Intelligence. So if you remember, I was like, man, that Apple Intelligence was a dud. The stock got murdered, and then the next couple of days, as everybody was downgrading it, the buyback machine turned on, and then it went crazy. So now we found out that Mr. Berkshire has sold off. We heard that about Bank of America last week or 2 weeks ago, and it had an effect. I do think this will weigh on the NASDAQ and other things as we get into this week. So watch out for Apple. Any Apple plays, I think, will be very interesting as we figure out who has more sway, either Berkshire or the buyback. So watch out for that. That is play number one. Then play number two. Oh, there it is, TLT. I did make a TLT play. So ever since that one video, when to buy TLT, I was telling you, I've been going back and forth with the bond plays, the ZB on the futures. I didn't really trade TLT at all this year. I think this is one of my first plays on it, but I've been going with the bond futures. We had a big one, 7-8 grand not too long ago after the Trump stuff. Then it bounced back, had a dip. I kept flipping it even right before here. I bought a bond right when Powell said September rate cuts, and then it started ripping. I got just under 2K, and I was like, yeah, I'm happy with that. And then Friday came around, and we would have made a killing. So since I didn't have any bond exposure, I thought, you know what? I might get a small play on the bonds, and here's what you have to understand. Do I think the big TLT play is here? No, not yet. Is the curve steepening rapidly? Yes, and you need to pay attention to that. And like we talked about last week, I would keep in hand up. I wouldn't go all in, but I would play defense, and I would make sure this is on your list. But the way I'm looking at it, I want a future position. So now it's moved up 3-4% even after I sold out within 24 hours. So I said, hey, let me go with an option, and then if it does somehow go crazy and I can't account for it, I'm not into play, those options can take off for us. And then if I'm right and then it comes back down, then I can just go buy my put on the first dip, and then we'll be good. And that's something I'll tell you right now. I've been saying this since we made the bond plays, and I even talked about it a lot on Friday. You know, this is vertical and TLT is exciting and a lot of people want it, but I promise you it's going to have a cool down. That's just how the bond market is. It overshoots on the yields and then it eventually comes down. So that's the thing. I don't know if you remember or if you've been trying to play TLT, but every TLT move over the last 4 years has been met with a swift rug pull. So sometimes it could really go October, November, but all I'm trying to tell you is that if you want to position on the red days, unless you are just trying trying to play the momentum. But if you're like, oh, I want it, you don't want to FOMO, just wait till you get your first pullback, and that's going to be a better time to build your position. So that's what I was saying here all day on Friday with this play, because I'm using these options. I don't think the options are going to hit. It's just to give you exposure. If things do go crazy, yeah, you'll be able to make a little bit here, but ideally, I don't want to risk too much at these positions and wait till there's a pullback, and then we could position big and go from there. So watch out for that. I think there's going to be a lot more of these. So as far as the play for TLT, I grabbed the August 16th 106 calls. I grabbed 10 of them for 7 cents. They went up 40%. Again, this was an insurance play. It's a little further out. 106 was where we were at a little bit of last year, but this is what I tell you. On the short side, if you really want to make a lot of money on the TLT play, we don't know what's going to happen. I don't know how we're going to wake up. I don't know the good news, the bad news, all of that. So maybe TLT does nothing. Maybe it does everything. But to make the most amount of money, you want to spend a little bit amount of money, but you want to get in the money. The way you're going to get clapped on TLT options is if you buy one that's way too far out the money. It makes the move. Maybe it gets a little bit of premium, but when it's all said and done, if you're not able to get in the money in that dollar for dollar, you're not going to make as much. So that's why I try to go shorter time on the call side and getting closer to the money while not spending as much. Again, 7 cents is a price that I like. And then if it does come down and we can't make anything off these, hopefully the yields chill out, have a breather for a day or so, and then we could position pretty nice. So that was the first play. The second play on terms of the TLT, I also grabbed puts. I grabbed 10 of the 90 puts for 20 cents, and I think there's going to be a pullback. So why I grabbed them was simply because I expected a pullback. I think TLT is bullish. I think there's a lot of things with the rates. I don't know where it'll end up because we don't know how the cycle process is going to play out. We don't know when the cuts are going to happen and how the data is going to look. That's why I was just sharing all of that with you in the beginning. But for the most part, I think if nothing happens, there will be a pullback, and I want to see if we could either monetize that through puts or get us a better entry as it comes down. So those are the first two plays. Those are the ones I made on Friday. Watch out for those. That's number 2. And then finally, play number 3, baby. This one, oh my goodness. What the heck? I'm trying to get you. I'm trying to isolate it here, make it a little. Oh, there it is. Disney. So this is still one of my favorites. Honestly, for earnings, it sucks because I don't know how the volatility is going to play out this week and how that's going to get in the way. But Disney has been one of my favorites. There's been a ton of good news with the movies and everything. They've just been selling off because people selling out. Nelson Peltz, the Marvel guy. People getting worried about even like Netflix and other things there. So I think they have a lot of good things fundamentally. I just think it's been a really rough quarter, a brutal quarter, and they've sold off 35% or something like that. So that's why I'm leaning towards the call side just in case they could surprise. But then again, if this environment doesn't really allow it, then maybe it's going to be a dud. So watch out for that. That is play number 3. And then as far as everything else, these were the only plays I made on Friday. I did the TLT both ways. I sold all of my MOs. Remember, we did an MO flip last week. That play hit 2,000%. It was like 3 cents into like 70 or 80 cents. I had 100 of them. I sold them out early to make them free. You would have made like 150 into like $7,000 or $8,000. I think it was something ridiculous, man. But I think I walked away with just under like $1,000. It was not bad though, considering how much we put into it. So watch out for that. And then I got out of my arm play, and then I did that Russell on ISM Manufacturing Day. Got absolutely murdered. So gonna either close that out for a loss or gonna try to push it a little bit. If we get the right instance here where we know we're gonna kind of be able to get green, I'll hold till green. But if things do get a little shaky, I'd be down to cut it out for a loss and then see where it takes us. But Chad, I don't have an economic watch list for you because your homework is to watch the video exactly when to buy TLT, and I want you to screenshot this right here. So everybody, 3, 2, 1, screenshot, sell the first rate cut. I want you to be familiar with all of the rate cuts since 1980 or 1970 and how things played out. And then, hold on, I also want you to memorize or screenshot and study the run-up to the first cut. I will get your economic lesson and all that later in the week, but I think with where things are going, we definitely need to pay attention to this. So, Chad, I love you all. I hope you enjoy it, but take That is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, it's one thing what you get out of it, but it's also what you could give and put into it. Oh, yeah, don't ever forget that, baby. Don't get blinded by the mission, but I love you, Chad. Drink that water, stay hydrated, healthy, all that good stuff. I'll see you in the morning, and on.